Friends, we are standing at a rare intersection of structural change and sentiment shift. The metal I'm talking about, silver, is no longer just the small sibling of gold. It's transforming into a workhorse asset with the firepower to move fast. We are poised at the brink of something far more profound than most recognize. The markets are moving into a space where history will look back and say, that moment changed everything. What we're witnessing isn't simply an upswing, it's a structural reset. Innovation is no longer a niche corner of finance. It is the foundation upon which economies, societies, and markets will be reconstructed. For too long, the status quo has dominated thinking: steady growth, moderate inflation, safe yields, incremental progress. But those days are fading. What lies ahead is powered by disruption at scale: robotics, artificial intelligence, genomics, energy storage, blockchain, all converging and accelerating one another. The old world of slow growth and predictability is giving way to a new world of rapid change. And the market is catching up, albeit reluctantly. Consider this: valuations built for a world of 2-3% growth are being applied to companies that have the potential to grow at 10% plus year after year. That mismatch is powerful. If you are still under the assumption that the next decade will look like the last, you are unprepared. The truth is, the next decade will not look like the previous one. We're entering a phase where conventional wisdom will be challenged and overturned. Simultaneously, we're seeing tailwinds that amplify this shift: monetary policy, inflation expectations, demographics. All of it is interacting with technological deflation, productivity gains, and shifting patterns of capital allocation. For instance, when innovation drives costs down, whether in computing power, gene sequencing, or battery storage, you get a built-in deflationary force. That deflation, paradoxically, supports higher valuations for companies that ride the wave of change rather than resist it. And herein lies the hidden dynamism. Most investors are still anchored in the past. They're analyzing the next few quarters, hedging for moderate risks, and asking, when will growth slow? But they should instead be asking, when will this new growth model ramp up? What does it mean when technology becomes deflationary, productivity curves steepen, and capital rotates into transformative winners? Because when that shift becomes obvious, markets can re-rate in ways that dwarfs what we've seen in the past. What makes this moment different from previous cycles is not just speed, it's the breadth of change. Innovation is no longer isolated to a handful of niche companies. It is spreading across sectors: healthcare, energy, transportation, computing. They're all being rewired. That means markets that were once comfortable with incremental change will now face leaps in value, often before fundamentals catch up. Thus the shock will come not because fundamentals fail, but because the market realizes the potential far faster than expected. Here's the critical point: being early is not a disadvantage in this environment. It's the only vantage from which you can participate meaningfully. Waiting until the evidence is clear means paying up for a story that's already become consensus. In contrast, positioning ahead of that recognition gives you asymmetric returns. And yes, this requires conviction, it requires courage, and yes, it entails risk. But the alternative, being left behind as transformation unfolds, is far greater. In short, the markets are not just adjusting, they are evolving. The next wave is not a rerun of the prior one. It will be wider, faster, and deeper. Those who believe that the worst is over, or will go back to normal, are likely unprepared for what's coming. Because what's coming is not more of the same. It's something entirely different, and the sooner we understand that, the sooner we can align ourselves to it. We are on the cusp of something massively disruptive in mobility, and the impulse to dismiss it as too good to be true is exactly what creates the opportunity. I'm talking about the upcoming revolution of autonomous ride-hailing, the so-called robotaxi model. What if I told you that a single company isn't simply selling cars anymore, but is re-architecting mobility itself so that every vehicle becomes a cash-generating machine? The implications are profound. When I look at this business, I don't see just another electric vehicle manufacturer building incremental growth. I see a company building a new platform, one that transcends the one-time sale of a car. Because once the car becomes a networked device that's out on the road earning money when you're asleep, when you're working, when you'd normally park it, you shift the paradigm. The revenue model flips from a finite transaction to recurring cash flows. That's the difference. The key is the timing and scale. If you assume that most of the value of this company 5 years out comes not from car deliveries, but from the fleet of autonomous vehicles providing rides on demand, then you begin to recalibrate valuation entirely. Simply put, the market is still largely assuming cars sold X price and growth Y%. But this thinks differently. It says, what if millions of cars are doing millions of rides every day globally with minimal operating cost because you remove the driver, you remove the idle hours, you optimize the network with AI, you harness the vehicle as both hardware and software, you monetize what was previously lost time. That's not incremental, that is exponential. Now, the competition isn't just other automakers anymore. The competition is technology platforms, data networks, fleet operations, artificial intelligence systems that learn and get better the more miles they drive. When those elements combine, you have a very different margin structure, a very different cash flow profile, a very different market capitalization potential. And I'll tell you, when a market misprices that kind of structural change, the upside can be outsized. Certainly, the risks are real: regulation, technology validation, consumer adoption, costing, safety. But if you're focusing only on will they sell more cars, you've missed the forest for the trees. The big bet is, when will this fleet-based ride-hailing operation scale? When will ownership shift to usage? When will the asset become a service? When will the recurring revenue swell? Because once that shift happens, and it often happens faster than headlines anticipate, valuations re-rate very quickly. Here's what's interesting. In this scenario, you don't just look at this company's next year's earnings, you look at the platform's potential. You look at the number of cars in the network, the number of rides per car per day, the cost per ride coming down, the capital cost amortization achieved, the data monetization, the network advantage. The platform becomes bigger than the sum of its parts. You begin to ask, what is the addressable market? What if the global robotaxi market becomes tens of trillions? And what if this company captures a meaningful share? Then you're not talking about 10-20% upside, you're talking multiples. What also fascinates me is how few investors are positioned for it. Many are lined up for EV growth in cars sold, but few are aligned with the shift into autonomous mobility as a service. If you're early, you might feel uncomfortable. If you're late, you'll pay for the feature. The lesson: being comfortable is often the enemy of being correct. And being early requires conviction, clarity, a long-term horizon, not blind optimism, but informed, extrapolative thinking. In short, this isn't simply car maker X sells more cars. It's platform X unleashes a fleet of autonomous vehicles, networked, dated, driven, global, scaling very fast, disrupting ownership, disrupting transport cost, disrupting urban mobility, disrupting the very notion of what a car is. And when that happens, the market will wake up, and it will likely wake up quickly. The market often underestimates the pace at which innovation compounds, especially when it comes to network technologies. Ethereum represents precisely that kind of exponential system, one that evolves, self-improves, and scales as adoption deepens. What most still fail to appreciate is that the comparison between Bitcoin and Ethereum is not apples to apples. Bitcoin is static, beautifully simple, yes, but deliberately limited. Ethereum is dynamic, modular, and adaptive. Its core function isn't merely to store value, it's to enable value creation, and that distinction could redefine the entire digital asset hierarchy. Bitcoin emerged as the first digital form of sound money, a decentralized, censorship-resistant store of value. That narrative has now matured, but Ethereum is pushing beyond it, functioning as programmable money and programmable trust. This means that while Bitcoin captures wealth through scarcity, Ethereum captures economic activity through scalability. Every time a smart contract executes, every decentralized exchange processes a trade, every NFT mints, and every tokenized asset circulates, Ethereum's network accrues value. It's not a passive store of value, it's an active, self-reinforcing ecosystem. What makes this transition even more profound is the evolution of Ethereum's infrastructure. With its move to proof-of-stake, energy efficiency has improved by over 99%. Transaction throughput has expanded, and yield mechanisms have emerged for validators. This changes Ethereum's economic profile entirely. It now behaves like a productive asset, one that generates cash-like flows in the form of staking rewards. In traditional terms, Bitcoin is gold. Ethereum, however, is an entire financial system, programmable, transparent, and globally accessible. The shift also reveals a structural advantage: flexibility. Bitcoin's rigidity ensures security but limits adaptability. Ethereum's open architecture, on the other hand, allows layer 2 scaling, roll-ups, and sidechains that exponentially increase its capacity. It's akin to the early days of the internet, when bandwidth bottlenecks gave way to fiber and wireless. Once that infrastructure scaled, the applications exploded. Ethereum is crossing that inflection point now. The arrival of real-world asset tokenization, decentralized identity, and institutional RaidDeFi is broadening Ethereum's base from crypto-native users to corporations, governments, and financial institutions. And that's where the power of compounding network effects begins to emerge. Bitcoin's network effect is monetary, driven by belief and scarcity. Ethereum's network effect is functional, driven by usage and innovation. The more people build on it, the more valuable it becomes. Each new project, each new developer, each new layer of capital compounds the strength of the base protocol. That's what transforms a digital asset into a digital economy. Another often overlooked factor is monetary design. Bitcoin's fixed supply is its strength, but also its limitation. It can hedge inflation, but not adapt to it. Ethereum's supply, however, is elastic, deflationary under heavy use, inflationary when needed to secure the network. That adaptive model, combined with fee burning, allows Ethereum to respond dynamically to economic conditions, making it both sustainable and potentially self-balancing. It evolves with the market instead of resisting it. Institutional behavior is already shifting in that direction. While Bitcoin ETFs symbolize recognition, Ethereum's integration into corporate blockchains and decentralized finance protocols signals utility. The question institutions are beginning to ask is not just should we own it, but should we build on it? And that's the turning point, because once you build on a platform, you're not just an investor, you're part of the network. So, if the next wave of adoption is not about holding but using digital assets, Ethereum sits at the center of that transformation. Bitcoin may continue to dominate the narrative of digital scarcity, but Ethereum could dominate the economy of digital utility. The world is migrating from assets that sit idle to assets that produce, transact, and integrate. When that realization becomes consensus, when usage metrics eclipse symbolism, Ethereum's market value could not only rival Bitcoin's, it could surpass it. What's coming isn't a competition between two cryptos, it's a handoff between two paradigms. One represents preservation, the other represents creation, and history has shown us creation always scales faster. Volatility is often misread as danger when, in truth, it is the language of transformation. In periods of accelerated change, volatility becomes not just a byproduct of uncertainty, but a signal that the market is recalibrating. When you stand at the intersection of technological disruption, macro realignment, and capital rotation, stability is not the norm, movement is. The faster the shift, the more dramatic the oscillations. Yet these fluctuations are precisely what clear the path for new value to emerge. What's happening now in financial markets, particularly in assets tied to innovation and scarcity, reflects that tension between the old and the new. Investors conditioned by decades of mean reversion and predictable cycles are struggling to process the speed of repricing. Historically, when technologies converge, artificial intelligence, decentralized finance, autonomous mobility, and next generation energy, volatility surges. That's not an anomaly. It's how the market digests exponential information in a linear world. Consider the mechanics. When capital begins to move rapidly from one regime to another, say, from legacy industries into digital platforms, or from fixed income into real assets, the revaluation doesn't happen smoothly. It happens in bursts. The old models break down faster than new ones can take root. The algorithms that track momentum and liquidity amplify those bursts. The result looks chaotic, but underneath the noise, a new equilibrium is forming. Volatility is the breathing pattern of progress. Still, we must recognize the risk embedded within that dynamic. Speed can magnify both opportunity and error. When an asset class moves 20% in a week or doubles in a month, human behavior becomes the variable that distorts fundamentals. Fear and greed alternate faster than rational analysis. Leverage builds, momentum feeds momentum, but in every cycle, those who can stay anchored to conviction, those who separate signal from noise, are the ones who compound the most when the dust settles. In innovation-driven markets, the risk is not in volatility itself. It's in misunderstanding it. Most investors treat drawdowns as failure when they are often merely recalibrations of future growth expectations. If you measure success by short-term stability, you'll exit precisely when the market is offering long-term asymmetry. The real risk lies in complacency, in believing that exponential growth will move linearly. It never does. Every wave of technological change has been punctuated by sudden corrections that shake out weak hands before the next leg higher. The macro backdrop only amplifies this. As monetary policy pivots, liquidity compresses and expands unpredictably. Inflation, rate cuts, and geopolitical shocks collide with structural innovation cycles. Each shock tests conviction. Each policy move rewires capital allocation. And because information travels instantly, the lag between perception and reaction disappears. Markets no longer absorb news, they react to it algorithmically. That shortens cycles and magnifies spikes. What once took months to reprice now happens in hours. But volatility, viewed through a different lens, is the cost of entry into exponential opportunity. It is the market's way of asking, do you truly understand what you're invested in? When you are positioned in assets transforming industries, energy storage, AI, robotics, blockchain, you are effectively buying into uncertainty itself. You're accepting that innovation doesn't move smoothly, it surges. The question is not whether volatility will persist, it's whether you are structurally positioned to withstand it. Managing risk in these conditions is less about timing and more about perspective. You can't control volatility, but you can design around it by allocating where disruption is defensible, by focusing on the long-term trajectory rather than short-term turbulence. Time is the great equalizer. Over a long enough horizon, volatility becomes background noise to those who remain focused on the exponential curve rather than its fluctuations. Ultimately, volatility is the manifestation of change colliding with resistance. And while the market treats that as instability, visionaries recognize it as opportunity. The fastest moves often scare out the crowd just before the real acceleration begins. To navigate what's ahead, you don't suppress volatility, you embrace it as confirmation that transformation is underway. Because the truth is, every era of massive wealth creation has started with a period that felt too volatile, too risky, too uncertain right before it rewrote the future.